Research has revealed Q1 results for national office markets, with figures showing negative net absorption of 65,000 square metres across Australia. Meanwhile, national CBD office vacancies increased slightly from 13.3% to 13.6% in the quarter. Joining us to unpack their findings is Head of Research Australia at JLL, Andrew Ballantyne. Welcome to the Urban Developer.
Thanks, Adam. Good to be with you today.
Now, let's start with the high-level results across the country. What is the health of office markets across Australia's major CBDs?
It's a great question, Adam, and ultimately we're on a journey at the moment. So 2020 was a very challenging market. We saw very low levels of activity and we saw a sharp increase in sublease availability. What we've picked up in 2021 is, while the numbers at a headline are still negative, is that we've started to see signs of improvement in the market. And what I would phrase is a re-establishment of the market. And what I mean by that phrase is we're now seeing inquiry and activity really pick up from smaller users. So typically organisations less than 500 to 600 square metres. And if you look at the level of leasing inquiry in both Sydney and Melbourne, and I appreciate this is off a very low base when you compare to 2020, we've seen a sharp increase from where we were over the past 12 months. So I would say the health is improving, but we still see across most geographies, with the exception of Canberra, higher vacancy. So there's still challenges to navigate through the remainder of 21.
Now let's talk about Melbourne and Sydney, obviously the two major employment centres most impacted by COVID last year. Can you describe how those two markets are holding up?
Yeah, sure. So you really need to split them out, because I would argue that they're both in different phases of the recovery journey. And we would say that Sydney's probably around 3 to 4 months ahead of Melbourne in terms of what we're seeing and inquiry and activity. So what we saw in both geographies was an increase in sublease availability. What has been interesting through Q1 is we've seen organisations, or some organisations that offered sublease, actually take that space back. We have seen new sublease opportunities also come to the market in both geographies in 21, but it does really show that a lot of organisations are still uncertain themselves in terms of what their space requirements are going to be, but more importantly, what their revenue outlooks are going to be over the medium term. So we're seeing quite a bit of movement in the sublease market, and it's very fluid when we look at both geographies.
And what about the impact of contracting and downsizing? At the same time, the economy's recovering much quicker than everyone expected, and there's this degree of uncertainty about what your spatial requirements are. How is that transpiring out there in the marketplace in terms of activity now this year?
There's still a level of uncertainty, Adam, and you touched very correctly on the economy. I think if you look back at what economists told us was going to be the trajectory for the labour market, there wasn't one that thought we were going to be sitting here today with employment levels back at pre-COVID levels. I mean, John Maynard Keynes very famously said, when the facts change, I change my mind. And economists have certainly changed their mind over the past 12 months in terms of the evolution of the labour market. And that's really flowed through to how a number of organisations are thinking about their own outlook. They're clearly seeing business conditions have been stronger. If you look at the NAB survey, business conditions are at very elevated levels. You also, as we touched on the labour market, ANZ do a really good job advertisement survey. That's at very elevated levels as well. And we're also seeing improvement in consumer sentiment indices. So the lead indicators that we're seeing are certainly improving at the moment. The challenge that a number of organisations have, and especially when you look at Sydney and Melbourne, where the re-entry or reoccupation rates are below what we see in the other geographies, is ultimately, what does the hybrid model look like, and what does that mean for my space requirement moving forward? There's a number of organisations are still actually navigating that journey at the moment, and I don't think we'll truly see the end of that journey. I mean, to be honest, it's a journey that evolves over longer periods of time until we've gone through the full vaccination process.
And what about some of the other major CBDs, Brisbane, Adelaide, Perth, Canberra? You mentioned Canberra earlier. How are they comparing to the Sydney and Melbourne story?
Again, you need to strip them out, Adam. Canberra is a counter-cyclical market. It's highly dependent on both the Commonwealth of Australia and the ACT government in terms of its demand profile. And we've continued to record positive absorption through the pandemic for the Canberra office market. And we've actually seen a significant reduction in A-grade vacancy within Canberra. So it's at the lowest level in about 10 years in terms of when you look at our data. So Canberra's been very resilient. Then when you look at the other markets, you haven't seen the same escalation in sublease availability that you have in Sydney and Melbourne. And that's quite an interesting observation to pick apart a little bit. And most people would look at those geographies and say, well, you don't have the same prevalence of multinationals. The tenant composition is largely orientated towards smaller users. And also the public sector is a reasonable occupier of those markets as well. Now, it's interesting because all of those reasons are very valid, but if you look back at the financial crisis, we saw the same level of sublease availability in Perth and Brisbane as we did in Sydney and Melbourne. So all those reasons were very valid back to that time period. So the main difference that I can see this time around is the reoccupation of office buildings. And the PCA have a great survey out there showing what their members have responded to in terms of office occupation levels. And as you would be aware, Brisbane, Perth and Adelaide are significantly higher than what we've seen in Sydney and Melbourne.
And look, what about some of the medium and long-term shifts now that are playing out? We talk about hub and spoke strategies, a lot of people working from home. What becomes now of the non-CBD office markets, and how are they shifting and adjusting in comparison to the CBDs?
Look, a number of the non-CBD markets have actually been fairly resilient, especially when you look at both Sydney and Melbourne. Now, I'm a big subscriber to trying to understand the why of a market. Why does a market actually exist? And it ultimately exists due to the organizations that want to be there, either due to close proximity to their customers, to their suppliers, or from a workforce catchment perspective. So a lot of the suburban markets exist then due to economies of agglomeration. So you get like-minded organizations that cluster there and they get the benefits of knowledge and technology spillovers. I believe that the markets, the suburban markets that are going to be successful are going to have very strong clustering. So if we look in a Sydney context, a market like Macquarie Park as an illustration has seen a lot of new capital go in and acquire assets in that market. And part of the reason is you've got exposures to growth sectors of the economy, technology, pharmaceutical and health, education, not at the moment, but over the medium to longer term. And then you've got the overlay of infrastructure. So they to me are the key drivers. And then hub and spoke is an additional ingredient. It's not the main story around what's driving those markets, but some of those markets certainly do benefit from the potential that some organizations will look to split their tenancy. And we believe in a Sydney context, the Macquarie Parks, Parramatta and North Sydney will be the three main beneficiaries.
So what does all this mean for values and transaction activity at the top end of town? Where will yields go over the course of the next 12 months? Can they continue to compress, or is it starting to move the other way?
Adam, every cycle has its own unique ingredients, and this cycle has certainly been no different in terms of having its own unique ingredients. And when you look at the trade of the larger prime grade assets, they've been very resilient. I think that's actually surprised some participants in the market, just how resilient they've been. And also what's been interesting is the diversity of capital sources that's actually been looking to acquire those products. So we've seen interest from groups out of Singapore. We continue to see strong interest from groups out of North America. And we also saw strong interest from groups out of Germany in particular. So there's a whole diverse range of capital sources looking at that top end of the market and still believing in a global context that Australia looks attractive. Now, if you start to look at some of the overseas markets, you start to see similar observations in terms of pricing trends. One of the markets I look at pretty closely in this region is Seoul. Seoul's a market which has gone through a re-rating, and we're now seeing trades in Seoul in the low to high 3% territory. So there's actually a positive yield spread between what we see here in Australia and what we see within a market such as Seoul. And we can start to replicate that when we look at other geographies. We've seen some strong deals go through in Paris recently, strong deal going through in Berlin, strong activity in Singapore. So that top end of the market continues to be well bid. The big risk that people talk about when they look at pricing is ultimately around bond yields and the reflation trade. There's very few investors there that believed bond yields were going to stay at 1% forever. There was always going to be a form of reversion. The reversion happened a little quicker than people expected, but most groups were looking at a figure of around 2.5% to 3% in terms of the reversion in bond yields. So until we get to that type of territory, the implied risk premium for core real estate still looks attractive. Does that mean we see significant yield compression? I think we see a modest yield compression, but ultimately people are very focused on that risk premium and the trajectory for bond yields over the medium term.
Well, it's always good talking with you. We look forward to chatting at the end of Q2. Andrew Ballantyne, thank you very much.
Thanks, Adam.